Hey, what's up everyone? Let's talk investing. Look, I know figuring out where to put your money can feel like navigating a maze blindfolded, especially when you're just starting out. You hear all this talk about stocks, bonds, real estate, crypto, and it's enough to make your head spin. Trust me, I've been there. But here's the thing, building a solid financial future doesn't have to be this complicated equation that requires a PhD to understand. In this video, we're going to break down 3 simple letters that can change the game for you. ETFs. Specifically, we're diving deep into the top 3 ETFs I would personally pick if I were starting my investing journey all over again in my 20s. We're talking SPY, QQQ, and SCHD. These aren't just random letters, guys. These are your tickets to a diversified portfolio that can help you weather market storms and come out on top. We'll unpack exactly what each ETF does, why it's earned a spot on my list, and how it can fit into your own investment strategy. Whether you're all about that aggressive growth, looking for some steady stability, or craving those sweet dividends, I've got you covered. So grab your notebooks, buckle up, and let's get this money. Alright, let's kick things off with the OG of ETFs, SPY, also known as the Spider S&P 500 ETF Trust. Now, if you're even remotely interested in investing, you've probably heard of the S&P 500. It's one of the most well-known stock market indices in the world. It's like the all-star team of the stock market, representing 500 of the largest publicly traded companies in the US. These companies are leaders in their respective industries. Think giants like Apple, Microsoft, Amazon, the companies that basically run the world. These are the titans of technology, retail, and more. SPY is an ETF that mirrors the S&P 500's performance. It tracks the index, giving you exposure to all those top companies. In simpler terms, when you buy SPY, you're essentially buying a tiny piece of all those 500 companies. It's like having a diversified portfolio in a single investment. It's like owning a slice of the entire US economy in one shot. You get to benefit from the growth of the American market as a whole. Now you might be thinking, Andy, why not just buy individual stocks in these companies? Why go for an ETF? Well, here's the beauty of SPY instant diversification. You don't have to worry about picking the right stocks. Instead of putting all your eggs in one basket, hoping that one company crushes it, you're spreading your risk across hundreds of established players. This reduces your risk significantly. This means even if one company has a bad quarter, or let's be real, a whole bad year, the impact on your overall investment is minimized. Your portfolio remains more stable. And let's talk about performance. How has SPY fared over the years? Historically, the S&P 500 has returned an average of around 10% per year over the long term. This is a solid return for any investor. That's not just some random number I pulled out of thin air. That's the power of compounding working its magic. Your money grows exponentially over time. Think about it. If you invest consistently in SPY, reinvest those dividends, and let your money grow over time, you're setting yourself up for some serious wealth-building potential. It's a strategy that pays off in the long run. Plus, SPY is incredibly liquid, meaning you can easily buy and sell it whenever you need to without any major hassles. This flexibility is a huge advantage. This is crucial, especially if you're the type who might need to access your funds quickly. Liquidity ensures you can convert your investment to cash without delay. But here's the real kicker. SPY is a long-term game. It's not about short-term gains. This isn't about getting rich quick. It's about building a solid foundation for your financial future. It's a marathon, not a sprint. It's about riding out the market's ups and downs, knowing that over time the American economy, and by extension SPY, has historically trended upwards. Patience is key. So if you're looking for a set-it-and-forget-it investment that gives you broad exposure to the US market and the potential for steady long-term growth, SPY deserves a prime spot in your portfolio. It's a reliable choice. Remember, investing is a marathon, not a sprint, and SPY is your reliable running partner for the long haul. Stick with it, and you'll be glad you did. Alright, now that we've covered the solid and steady SPY, let's turn up the heat a bit with QQQ, an ETF that's all about embracing the future. This bad boy tracks the NASDAQ 100 index, which is heavily weighted towards, you guessed it, technology companies. These are the companies that are not just participating in the market, but are actively shaping it. We're talking about the innovators, the disruptors, the companies pushing the boundaries of what's possible. These are the firms that are constantly evolving and redefining industries. Think Tesla with its electric vehicles and renewable energy revolutionizing the automotive and energy sectors. NVIDIA powering the future of artificial intelligence, providing the computational power behind cutting-edge AI developments, and Meta connecting billions of people worldwide, transforming how we communicate and interact on a global scale. Now I know what you're thinking, tech can be volatile. The rapid pace of innovation means that these stocks can experience significant ups and downs. And you're right, it absolutely can be. The tech sector is known for its dramatic swings, which can be both thrilling and nerve-wracking. But here's the thing, with volatility comes the potential for massive growth. The same factors that make tech stocks risky also make them some of the most rewarding. Look, over the past decade, the tech sector has absolutely exploded. Innovations have driven unprecedented growth, creating new markets and opportunities. The rise of smartphones, cloud computing, e-commerce, it's been a wild ride, and QQQ has been at the forefront, capturing those gains. This ETF has been a key player in harnessing the growth of these transformative technologies. Of course, past performance doesn't guarantee future returns, but the trends are clear. Tech is here to stay, and it's only going to become more integrated into our lives. The digital revolution is far from over. Now, QQQ isn't just about big tech giants. It also includes companies from other sectors like healthcare, consumer discretionary, and communication services, which are increasingly leveraging technology to innovate and grow. But make no mistake, tech is the driving force behind its performance. The tech sector's influence is pervasive, touching nearly every aspect of modern life. So why choose QQQ over SPY? The answer lies in your investment strategy and risk tolerance. Well, if you have a higher risk tolerance and believe in the long-term growth potential of the tech sector, QQQ offers more targeted exposure to those companies that are shaping the future. It's about betting on the next big thing. It's about capitalizing on the innovation and disruption that's happening right before our eyes. These companies are not just participating in the market, they are redefining it. However, it's important to remember that with higher potential rewards come higher potential risks. The tech sector's rapid pace of change can lead to significant volatility. The tech sector can be sensitive to interest rate hikes, economic downturns, and of course, the occasional hype cycle. These factors can all impact tech stock performance. That's why it's crucial to consider your own risk tolerance and investment goals before diving headfirst into QQQ. Make sure it aligns with your overall strategy. If you're someone who panics at the first sign of a market dip, this might not be the best fit for you. The tech sector's volatility can be challenging for some investors, but if you're willing to ride out the volatility and hold for the long term, QQQ could be your ticket to supercharging your portfolio's growth. Patience and a long-term perspective are key. Just remember, diversification is key. A well-diversified portfolio can help mitigate risks and provide more stable returns. Don't put all your eggs in the tech basket, no matter how tempting it may seem. Diversification helps balance the potential highs and lows. Balance it out with other investments like SPY to create a well-rounded portfolio that can weather any storm. A balanced approach can help you achieve your financial goals while managing risk effectively. Alright, let's switch gears and talk about something a little different: dividends. Now, dividends might not sound as exciting as high-flying tech stocks, but trust me, they're the secret sauce to building long-term wealth. They provide a steady stream of income that can be reinvested to compound your returns over time. Think of dividends as passive income streams generated by your investments. It's like having a second paycheck that you don't have to work for. Instead of just relying on your investments to grow in value, dividends put cash directly into your pocket, which you can then reinvest and accelerate your returns. This reinvestment can significantly boost your portfolio's growth over the long term. And that's where SCHD comes in. This ETF is designed to help you tap into the power of dividends. This ETF tracks the Schwab US Dividend Equity ETF Index, which focuses on companies with a long history of paying and increasing dividends. These companies are known for their financial stability and commitment to shareholders. We're talking about the Dividend Aristocrats companies that have increased their dividends for at least 25 consecutive years. This kind of consistency is rare and valuable. These are the stalwarts of the market, the companies with solid business models, strong financials, and a commitment to rewarding their shareholders. They are often leaders in their industries. Think companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble, household names that have been around for decades, weathering recessions, market crashes, and everything in between. Their resilience makes them reliable dividend payers. Now, SCHD might not experience the explosive growth of QQQ, but it offers something equally valuable: stability and consistent income. This can be particularly appealing during volatile market periods. Remember, dividends are not guaranteed, but companies with a long history of paying and increasing them are more likely to continue doing so in the future. This historical reliability can provide peace of mind for investors. This makes SCHD an excellent choice for investors looking for a reliable source of passive income, especially those nearing retirement or seeking to supplement their income. It can help ensure a steady cash flow during your golden years. But here's the thing, SCHD isn't just for retirees. It's also a great option for younger investors who are looking to build wealth over time. It's a fantastic option for younger investors as well. By starting early, you can take full advantage of the power of compounding. Why? Because it teaches you the power of compounding and long-term investing. The earlier you start reinvesting those dividends, the more you can benefit from exponential growth. By reinvesting those dividends back into SCHD, you're essentially buying more shares and increasing your potential for future income. This can create a snowball effect where your returns grow larger over time. Plus, SCHD offers diversification across various sectors, including consumer staples, industrials, healthcare, and financials. This broad exposure helps mitigate risks associated with any single industry. This means you're not overly exposed to any one particular industry, reducing your overall risk. Diversification is a key strategy in managing investment risk. So if you're looking for an ETF that provides a steady stream of passive income, invests in companies with a proven track record of dividend growth, and offers broad diversification, SCHD is definitely worth considering. It combines income, growth, and risk management in one package. Remember, building wealth takes time, and SCHD is like the tortoise in the race, slow and steady, but ultimately reaching the finish line with a hefty portfolio and a stream of passive income. Patience and consistency are key to long-term financial success. There you have it, guys. SPY, QQQ, and SCHD, three powerful ETFs that can form the foundation of a rock-solid investment portfolio. Remember, investing isn't one size fits all. The best ETF for you depends on your individual risk tolerance, financial goals, and time horizon. Do your research, understand what you're investing in, and don't be afraid to start small. The most important thing is to get started and stay consistent. Now, I want to hear from you. Which of these ETFs are you most excited about, and how do they fit into your investment strategy? Let me know in the comments below. And hey, if you found this video helpful, don't forget to give it a thumbs up and subscribe for more investing tips and tricks. Until next time, keep learning, keep investing, and keep crushing it.